Hey everybody, just a quick update on the markets. So we had some key economic data released. Obviously the big headline number is the CPI, Consumer Price Index, which monitors inflation on the consumer side. That has come in at 9.1%, beating the market expectations. And what we initially saw was a sell-off in the markets because when inflation is still peaking and running higher, it means that central banks have to be a little bit more aggressive with the tools that they implement to fight inflation and try to bring that down. And arguably, you can say that we already saw a more aggressive central bank from the Bank of Canada. The Bank of Canada was set to raise interest rates by 0.75%, but they actually went ahead and raised it by 1 full basis point. So it kind of spooked the Canadian market, and I don't think they're done raising rates yet. That's why there's going to be tremendous implications on asset valuations, and specifically the assets that haven't devalued yet, like the real estate sector. So that being said, with a 9.1% reading on the CPI today, tomorrow or Friday, I'd have to double check, but we get the PPI, the Producer Price Index, which tracks inflation on the producer side, so the corporate side. And arguably the PPI is a little bit better in my opinion to follow because it does show you the producer side, which obviously dictates more or less of where the economy is going. So that being said, if we get a decline on the PPI, it stands to suggest that inflation has peaked. And one of the reasons we here at Trading Capital think inflation has peaked at the 9.1% is simply if you look at the commodities, oil, the most used energy in the world, copper, the most used base metal in the world, those two single commodities alone with a whole variety of other commodities have seen significant declines over the last 30 days. And the reason why the 30-day decline that commodities have recently gone through isn't reflected in this current reading is because the CPI is always delayed by 1 month. So the next CPI reading will take into account all of these collapses in commodity prices, as well as the fact that these interest rate hikes will have an extra month to work itself through the system. So I do think we've reached that peak inflation. You are starting to see some weakness in the US dollar as well, which will be positive for the overall stock and equity markets. But there's still tons of economic data that is coming out as we progress to the Federal Reserve meeting at the end of the month. So let's stay tuned. I think peak inflation has hit. We're starting to see equity markets potentially form a little bit of a short-term base to have a little bit of a move up. Overall, the big macro trend is still massively a downtrend. I don't think we're out of this bear market. Even if inflation peaks, knowing the cycles and what that means and what is next, it's a positive that inflation peaks, but that generally has other consequences that you have to take into account. And there's always there's always a beginning, a middle, and an end to this recession. Generally, recessions will take anywhere from 12 to 36 months, potentially longer in some cycles, but that's generally the average time frame. We're roughly 6 months in this, so one could argue we're still at the beginning process, and we're likely going to transition into the middle and latter half of this recession as things progress. And the latter half is where things really get extra volatile and certainly never a good thing for valuations, asset valuations. So stay tuned for more updates, but we believe peak inflation has hit.